Paul, quite often we analyze companies and we get slayed in the comments that we're clowns.
We don't get slayed. We get trolls to comment to us about things.
That we don't do enough due diligence. That we'll do videos on companies. We have no idea what they do, where they're growing. Obviously, future projections are always where most people look. What analysts are saying, what's ahead in the pipeline. And I actually challenge you on this at times because I say, boy, I wish we did more research on this. And then I've come to a revelation about like more research-based YouTube pages and ours. So describe your thought process.
First off, just because other places read the news doesn't make them research-based.
That's true. I mean, they are just regurgitating the news. And I do know that people turn to YouTube to get a recap on the news on some companies, but I don't know if those people are actually investing any amount of money like you and Mo are in some of these companies. I mean, like we talked about Alibaba. You're saying you buy like thousands of shares at a time. Meanwhile, these folks are like sitting in their spare bedroom making videos. So what is your thought process about fully looking into a company before investing in it?
So there's a book called Blink, written by Malcolm Gladwell. Do you remember this book?
I never read it. I don't read books.
It's a great book. And the reason I love it so much is, Seth, you're a photographer, right? Mm-hmm. By trade.
Yeah.
When you see a picture, how fast do you know if it's a good picture or not?
Yeah, you're right. Very quickly. Your mind.
If I see a picture, how long would it take me to know if it's a good? I will never know if it's a good picture or not.
I guess you're right.
I once took the photo on my phone right now is of my niece. Mm-hmm. I took a picture of my niece. You and Beth saw it. You're like, Paul, that's an amazing photo. I go, really? They're like, yeah. Look at the light. I'm just like, oh, right. I literally just happened to like take 7 pictures of her, and that was a good one.
Right.
That was it. What the book Blink is about is, once you become aware and become more of it, you don't even become an expert. But once you're in the world of understanding things, you can look at things very quickly and say, is this good or not? Is there something, how many times have I said, I remember people coming to me all the time and say, Paul, look at this piece of real estate, look at this company. I'm like, oh, that's a fraud. What do you mean it's a fraud? It's a fraud. They're lying, but they don't know what they're talking about here. They're either lying to you on purpose or they're just morons. It's one of the two. And sure enough, I don't think I've ever had one not be right in that fashion. Either it was a fraud or the person had no idea what they're talking about. So, due diligence. I find that people do due diligence ahead of time when they're trying to convince themselves and justify an investment. Mm-hmm. My goal is the opposite. There are 10,000 plus companies out there. My goal is to pick the ones I know what drives value over long term. Revenue growth, profit growth, free cash flow growth, right?
Yeah.
These are the things that drive. I'm going to go focus on those attributes to start. I'm going to look at the 500-foot view. When we have our software up, I'm going to look at the 8 pillars and go, okay, maybe that's a bad example because of this. 8 pillars of Facebook. I look at this going, immediately I say, okay, Facebook's expensive. Everything else I like. Should it be more expensive? Should it be less expensive? That's my goal. I'm trying to start from a high level and weed out all the crap out there. What's all the crap? The company that's issuing tons of shares every single year. The company that's not generating a lot of revenue growth and selling for a really high multiple of revenue and profit. Why even waste my time? Paul, you're missing out on growth potential. Maybe I am. But for the 1 in 1,000 that's the right deal, I'd rather go find the other 20, 30, 40 companies, the 200 companies I like, that I can then go do more research on to find the 20 or 30 or 40 that I want to buy.
Paul, there are a lot of famous YouTube channels that you end up becoming like echo chambers of themselves. If you get interested in Tesla, the next guy is just going to promote what's happening in the future. What if they build this, when they build that, they're going to have this many batteries.
That's not investing.
And I talk to
myself. That's hope and prayer.
Yeah, I have these conversations, but boy, your investing strategy sounds like it's a lot of what ifs. If this happens, maybe.
By the way, all investing is. The future is unknown. That's what makes investing hard. We don't know what the future is going to happen, what's going to happen in the future. My style is, I'm not looking for the needle in the haystack that'll become the next biggest company in the world. I'm trying to look for the companies that are being overlooked, that are selling for reasonable multiples, that are still growing in some fashion. I don't need growth. I need 2, 3, 4%. As long as the growth is factored into the price, I'm a happy camper.
And I think this is the difference of this channel. And Mo shared this in a group chat. Mo, tell him about Warren Buffett's quote you shared yesterday about growing.
Yeah, Warren Buffett, it had Jeff Bezos asking the question of, Warren, your investing style is so simple. Why doesn't everybody do it? And he said, because nobody wants to get rich slow.
Yeah, in the
simple as that.
In the day and age when cryptos are going up multiple percentages per day, this sounds boring, stupid, and out of touch, Paul.
I got a message on Instagram, which I didn't respond to, but somebody messaged me on Instagram, by the way, follow me below. And they said, Paul, why should I invest in Intel making 0.5% on a good day when I can invest in, what was the company? Might have been Palantir.
Yeah, pick one.
Pick one that's growing 5% per day. I didn't even respond because I'm looking at him going, this is not the person for the channel. And the reason being is I look at it as over long periods of time. You look at Cisco. I look at Cisco and Intel, and this is our prime examples. Cisco and Intel. Look at this price, $80 a share. 20 years later, it's at 55. This was 20 years ago, guys. Guess what? Since then, revenue has increased 4.5 times, and profit is up over 5 times. Guys, if I told you on this date right here that revenue in the next 20 years will be up 4.5 times and profits will be up 5 times, would you have told me the stock is going to be lower 20 years later than it is today?
Well, you say the same things, and the comments say exactly what you're saying. I mean, we tell people this could not happen, and they tell you you're out of touch. You don't get it, Paul.
I've literally had people say to me, Paul, you're telling me if blah, blah, blah company doesn't grow 10 times in revenue, it's not going to. No, it's not going to. If you pay too much, if that's the case, why don't they pay $500 a share? Would you have paid $500 a share saying, oh, it's going to grow up it's going to go 4.5 times, because there's still a valuation metric you have to care about. And by the way, this is the only example of this. Even Amazon was at $113 a share. And now it's at $3,300. That's an increase of 2,000 times, call it. 200 times, call it. 20 times, 20 times. Guess what? The revenue is up 200 times. So even if Amazon at $113 a share back in 2000, and it's already way higher, 20 times more, the revenue and profit, it wasn't even making money back then. The revenue is up 200 times, and the company's only up 20, and it's overpriced today. So I look at this saying, wait a second, guys. There has to be, you could have done all the research in the world. This company's going, yeah, but if you're paying a terrible multiple, it doesn't matter how much research you do. Cisco's up 4.5 times in revenue and 5 times in profit. You could have been 100% right on that here and still been wrong. Why? Because you overpaid today for revenue and profit. You overpaid in 2000. That's what matters, guys. And they bought back how many shares along the way. So it should be even lower. If you overpay too much for growth, it doesn't matter how much growth you have, you can still fall.
So are you saying sometimes this due diligence just gets you into this echo chamber of what future projections
Due diligence should be used when the other numbers make sense to weed out the crap that you're missing.
Seth, if you look at that interview that I sent you last night about Manesh Prabhai, he said in there, he said, I don't do due diligence until the same thing. He said, I take 25 to 30 seconds. I look at a company, I look at the numbers, and if it doesn't make sense to me, it's gone. He said, I look at Amazon now. Doesn't make sense to me. Gone. That's it. It's just as simple as that.
He said that in the video?
He said that. He specified
and people
Amazon.
And guess what? Warren Buffett will literally make a deal in a hand. I once heard Warren Buffett owns a company, I think it's Elkhart, Indiana. He literally said, for all I know, there could be an empty warehouse there. I've never been there. I remember once somebody saying to me, like, oh, you don't go to every single one of your properties, No. Why? Because I have the right people who do the right things for me. That's it. If your thing is, I do so much, how much due diligence you do when you bought these shitty stocks? Congratulations. You sucked. Cisco, you could have been spot on in Cisco. You could have been 100% right. It's going to grow revenue 4.5 times and profit 5 times the next 20 years. And guess what? You still lost money.
Still bombed.
Why? Because you overpaid for that. Because you didn't care about what you're paying today. I mean, I literally get passionate about this because literally I have people say to me, Paul, you're telling me the revenue doesn't go 10 times, stocks go, no, it could very well not go. If you pay too much for it, my argument is, okay, fine. At this price, did it justify? I would have told somebody back then, great, it made $2 billion. Let's say it grows 10 times. It's $10 billion. That is $4 a share, whatever the number is. Is it worth paying $80 for $4 a share? Somebody might say, yeah, it's only 20 times earnings. Yeah, but that has to be for today. You're waiting 20 years later. You're overpaying for today. You're not even breaking even. If you think that's okay, we're not the channel for you. Hit the unsubscribe button. Do whatever you want to do. But that's not the way it works. If you're looking at due diligence first, you're trying to find the story and you don't care about the value. You're going to get immersed in the story.
You're trying to find a story and then create your own narrative, not the actual narrative.
And you're trying to sit there and justify the really high price today. The auto industry and the airline industry. 100 years ago, how many car companies and airlines were there?
There was 3,000.
3,000.
And guess what?
Auto,
You're telling me the average household now has like 2 point some, I don't know what the number is, 1.5 cars.
Yeah.
Amazing growth in auto. Amazing growth in the internet. And companies still went under. Why? Because people overpaid.
So how do you get to this comfort level when the second most popular comment we get besides from the haters is that we didn't do our due diligence, is that you're going to miss out on this, Paul?
I love missing out on every great investor. Their mistakes are omission mistakes, which means they didn't buy the 1 in 1,000 company that went to the moon. Okay, great. I've had mistakes of omission. I'm fine with that. I don't mind losing out on a potential great deal. Because you know why? If I deviate from my process, I will lose more money in the long run. I won't make as much money in the long run. But if I stick to my process, naturally companies will do better than I expect them to do. Fine by me. Look at Amazon. I was wrong on Amazon completely. But I still think Amazon's overpriced today.
So the final question I get, Paul, or the final question I ask you is, how do you bite your tongue when you have, well, that's true. How can I start biting my tongue when I go to a fireside chat, not a fireside chat, when I go to a cookout or something, someone brings up how amazing Tesla's going to be. How do I?
You know what you do? You bring up Cisco and Intel as an example. Be like, let me ask you a question. Cisco was selling for $80 in 2000. Since then, revenue is up 4.5 times and 5 times. Where do you think the stock price is today?
I see.
And they say $300. Nope, it's $55.
But Tesla's different, Paul.
And guess what? Cisco was different back then, and Intel was different back then. And the 4 most dangerous words in the investing world is, it's different this time. And Tesla could be different. It won't end up being different.
And just end your conversations with, let's have this conversation in a decade.
But guess what? They will have an excuse as to why it didn't work out. Of course they will.
But they'll still not have that money in their pocket.
It's no different than the person I know who bought a house in Miami for $375,000 in 2006. Sorry, $450,000 in 2006, and they're now selling it for $375,000 in 2021. And remember, Miami's population has grown how much in the last 15 years? So when everybody, I always love it. I've said on panels with billionaires before, and they say, buy properties in areas that are growing.
Yep.
That's all that matters? Yes. No matter what value, just buy property. Okay, sounds good. And that's what happens.
It's not what you buy, it's what you buy it at.
What you pay.
What you pay, that's right.
Relative to value.
That is our take. I guess we might have sounded a smidge defensive in this because, you know, we do. This is a lonelier road, Paul. I mean, I do not go to these same cookouts and hear people who ever sound like us, true value investors, which happen to sound like a lot of the most famous investors of all time.
And you know what the funny part is? They'll quote those people.
They will.
And they'll say value's dead, and then in another conversation say, you know, if I buy this at this sum, it's really a value play.
They do
but if
say
value
that.
If value investing is dead, why are you bragging about being a value play? You know why? Because you're insecure and you realize you're wrong.
It's so funny. On the morning show yesterday, there was a story about Warren Buffett because they're Berkshire Hathaway reported. I said, Warren Buffett is a genius 5 days a year, and that's it. It's on all 4 quarterly earnings, and then at the annual meeting. Every other day, he doesn't know.
No, they talk about how a genius is, but then look how old he is. I had somebody recently tell me, like, yeah, but Warren Buffett hasn't beaten the market in 10 years. You mean in the most overpriced market of all time when he has $250 billion to deploy? Like, of course he's not going to beat the market.
So funny.
Yeah, if this sounds foolish, just do any research at all on a lot of famous investors, and it'll start sounding exactly the way they do things. So that's our take. If this resonates with you, join our Patreon. You can join our team of people who think just like this, and you're creating. We're creating investing habits that can last a lifetime, not just through a 5 or 10 year bull market. And so we want to develop disciplined habits for long-term wealth, not crazy habits of daily wealth.
Follow me on Instagram at Paul Gabriel. Follow Mo at Trader Mo _EM at
Seth
Kerchanan on Instagram.
That's our take. Follow the thumbs up on the way out. See you on our live streams. Thanks for watching.